This is Christian Baldwin with Black Diamond Mergers and Acquisitions. I'm here with B.R. Price and Alex Miller at RMP in Northwest Arkansas. Can everybody hear us okay?
Yeah.
Yep. Okay, awesome. Great. Well, we're going to get started. It is 11 a.m. Central. Thank you so much for joining this webinar today. We like to do one of these each quarter, and I'm pleased to be with BR and Alex, who are good friends of mine and done a lot of work together over the years, and they do great legal work for their clients. We are going to keep this at 30 minutes of content, and then we will allow for 15 minutes of Q&A beginning at 11:30. So if you have any questions, be sure and bring those up to these guys who are experts in their fields. Would you guys like to give a quick background on each of yourselves?
Yeah,
Alex?
Yeah, I'll go ahead first. Pardon me, I'm getting over a cold, so I may have to cough a little bit in between, and I'm not really sure where I should be looking, if I should be looking at the camera or the laptop. But as Christian said, I'm Alex Miller. I'm a partner here at RMP. I'm a tax attorney. I really focus my practice in three different areas, which is estate planning, business transactions, and then tax controversy matters. And so all that really means is, you know, I've got an accounting background, accounting degree, and then after law school went off and got a master's in tax law. And so it's really beneficial. As you'll hear today, we'll talk about quite a few tax issues when setting up a business or, you know, buying and selling a business. And so also that comes in handy when doing estate planning, and then obviously representing clients and with controversies with the IRS or the state of Arkansas. But I've been with the firm since 2006. When RMP was founded, I guess there were 4 or 5 of us at the time, and we were really founded as just a bunch of tax attorneys, kind of a boutique law firm where everybody, probably the first 7 attorneys that started here at this firm, this is all we did was these 3 different areas of law that I just mentioned. And so that's me in a nutshell. So go ahead, BR.
Sure. I started working for RMP in 2011. I've got a banking background before I went to law school. I worked in banking on commercial lending and accounting for 7 or 8 years between undergrad and law school. And my practice is focused mostly on, I do a lot of transactional work, whether it's people buying and selling businesses, real estate, that kind of stuff, or helping people finance deals. And estate planning, that's 95% of what I do. So, but yeah, so that's kind of, this topic's kind of between Alex and I, is kind of in our wheelhouse. So excited to talk to everybody and answer any questions.
So guys, when we're doing a mergers and acquisitions deal, one of the big decision points that a selling client has to make with, you know, our guidance as a collective deal team is going to be whether we would recommend an asset transaction or a stock transaction. So what are some of the things that the seller needs to think about, or even the buyer maybe, regarding those decisions? How do they decide which is a better route to take?
So if you want, go ahead and start off if you want, or I can.
Well, yeah, I mean, the general rule, taxes is obviously a big issue, but that's not the only thing to consider. But that is one of the main issues. And I think, Christian, you do deals all the time. I think the general rule is the buyer usually wants to do an asset sale, and the seller usually wants to do a stock sale for tax purposes. A stock, you know, I don't want to talk under, everybody may already know what the difference is, but an asset sale just means, let's say you own your business as an LLC or a corporation, an S corporation, C corporation. With an asset sale, you're just selling a portion or maybe all of the assets that's owned by that corporation or LLC. So it may be all the real estate, it may be, you know, intellectual property, it may be inventory, equipment. Whereas a stock sale, you're not selling the individual assets, you're just simply selling the actual stock of the corporation or the membership interest of the LLC. And, you know, usually a stock sale is easier from a paperwork standpoint. It's easier from just an asset purchase, there's a lot of different moving parts. So obviously the legal expenses, in my opinion, are usually a lot more when you're doing something like that. But the tax benefits from, if it's an asset sale, the buyer, and again, it depends on the type of business and the type of assets that are there, but what the buyer can usually do with the assets that it buys is it gets a stepped up basis, meaning whatever it pays for those assets, let's say it's $100,000 that you pay for the assets of the company. After you then, start operating that company, you can depreciate or amortize for tax purposes the value of those assets over a period of years. And we'll get into this in a minute, but it depends on the type of asset as to how long you can write it off over, whether it's 3 years or 7 years or 39 years, depending on what it is. But so obviously the buyer wants an asset sale because of the future tax benefits of deducting depreciation and amortization. The seller generally, from a tax standpoint, wants to sell stock because of capital gain treatment. As long as they've owned the stock for over a year, usually they're going to get lower tax rates because the stock will be treated as capital gain property. And so, usually 15 or 20% would be the tax rate. Whereas if they're selling assets, and we'll get into specific assets in a minute, but a lot of times, some of the assets may be capital gain, but a lot of the assets that are being sold are usually treated as ordinary income property and obviously taxed at higher tax rates, which could be as high as 37%. So that's usually the first thing we look at, is just the tax issues. If you want to chime in on some of the other issues.
Yeah. And some of it, there's obviously other things that go into it. There's the liabilities that the company may have. If you're buying the stock of the company, you're getting the company, and that includes the good and the bad. So deals can be structured with some indemnification and stuff like that to try and counteract that to a certain extent. But just as a general rule, when you're buying the stock, you're kind of getting the good and the bad. Whereas asset deals can be structured to say, we're not going to, the purchaser's not assuming any liabilities of the company, or there's a list of what is being assumed versus not being assumed. And from a stock sale perspective, depending on the structure of the company, if you've got multiple owners and that sort of thing, it can be a little different depending on how it's structured and that sort of a thing. Whereas if it's just the company selling the assets, generally, if you've got the requisite amount of owners that can approve that type of a deal, then you can get the deal done. Whereas if you're trying to buy all the stock and you're dealing potentially with a lot more parties that may not all be on the same page.
Sometimes it's helpful to think from the closing backwards to whatever point you are in the deal process, just to get a feel for, okay, how's this really going to shake out in the end? And one of the things, if we're doing an asset deal, that you have to do is you have to tell the IRS, right, the asset allocation, and both parties have to agree on that. You can't, the buyer can't tell the IRS, oh, I bought the assets for this certain amount, and here's how we're going to do the allocation. The seller tell them something different. They have to agree on that. So how do we handle that in the deal process, right? There's a form at the very end that you guys handle for the asset allocation, telling the IRS that this is what the parties agreed to. That there can be a lot of negotiation ahead of time. I know we've had one where we spent a lot of time negotiating just the allocation of the assets once you get past the total purchase price.
Yeah, and it's funny when you get involved. I mean, as the attorney, you never know. Sometimes your client will come to you before they've even started negotiating, but a lot of times deals fall in your lap as the attorney after there may already be a letter of intent, and maybe the parties have already agreed, hey, we're going to do a stock sale or an asset purchase sale. But then it becomes clear when the client gets in front of you, they don't even really know that, the ramifications or the consequences of either one. And so as the attorney, sometimes we get accused of being a deal killer or something like that, but really we're just coming in and trying.
Not these guys though, not those guys, right? I
mean, any attorney that does enough of these, they're going to be called that at some point, but all you're doing is pointing out to your client, hey, I had a situation where I was representing a client that was buying a security company, and it was structured as a stock sale. And I was telling them, well, you know, you're assuming all of the liabilities that this company, if you're going to buy the stock, if that company owes any debts, or, you know, if there's any potential claims against that company from work that this company did, and they had installed a bunch of security systems and, you know, things at some schools, and maybe had done some work without proper licensing from some government agencies that we found out about. And, you know, whether it was a big risk or not, if the government would have come in and figured that out and hit them with penalties or whatever, my buyers would have assumed that risk and would have been responsible for those liabilities. And so, you know, there's just things like that we point out. Christian, I don't even remember what your initial question was. Just kind of,
I'll piggyback.
right?
So
Yeah.
on
allocation,
allocating, allocating your purchase price or allocating to the certain assets is obviously both sides generally have different motivations there, and so
because you're taxed different on
right.
one.
Yeah.
Right?
So your purchase, I mean, it may require a purchase price adjustment to. Generally, we can have a pretty good idea of the tax implications for at least our client, and if we have enough information both, and kind of work through that and just have a discussion of, well, okay, if we do it this way, I'm going to have this much more I'm going to owe in taxes on it, and I'm going to realize less at the end. So if we're going to do it this way, I want to change the purchase price to either increase it, decrease it, or we meet in the middle somewhere. So yeah, but sometimes that is an afterthought, because, you know, not everybody goes directly to taxes when they think of something. That's just us, because we're
Right, and that's really why we're so focused on the entire deal team to look at the entire big picture, because when you can get to those discussions about allocation, that can also lead to negotiation. Another thing to consider along those lines is, you know, the buyer may have taken the real fair market value of the assets to his lender, right? And they may be basing, you know, at least a percentage of their loan on the asset value of certain hard assets, not goodwill. So if the allocation is too far out of whack from what he's already gotten financing approved for, then the whole deal can fall apart, right? And so you want to make sure that everybody is understanding on all of the detail that can fall out over that. So on an asset transaction, Alex, you mentioned, you know, the assets that are owned by the corporation, right, which would be obviously hugely important. BR and I were recently working on a deal where we are representing the sellers as a collective deal team, and they have an S corporation with 3 shareholders, one of which retired last spring. And so the shareholders had gotten together and said, hey, look, since you retire, between the time you retire and the time we sell the company, we are going to not distribute any of the profits to you since you've retired. Is that okay? And they all agreed on that. Well, then when we got involved, the S Corp is the owner of not just the operating business, but the real estate and another unrelated investment vehicle and some other things. And then we decided, you know what, we're proceeding down the road now of a stock sale, and at closing, who's going to get paid, right? You brought that up, BR. So walk us through that and
So,
some of the traps there.
And part of that is just, you know, and this was a family business. You get complacent on, you know, making sure you're doing the documentation of certain things, whether it's keeping board minutes and that kind of stuff, or in this scenario, it was it's 3 brothers they just had an agreement that, hey, you're not getting the profits anymore, but you're still a stockholder and stuff like that. Well, that at the end of the day, when you get to closing, you got a settlement statement, everybody's getting paid for their stock that they own. And sometimes you go and look and we don't really know who owns.
Right, because
who owns what.
2 of the shareholders said, no, we're the current shareholders, not the one that retired. Well, we didn't want to accidentally trigger the loss of the S Corp election,
Sure.
which is one thing. And the other part was the guy that retired, although he had agreed to that, no one really explained to him that by virtue of that agreement, he no longer had any interest in the real property or this other investment that was on the balance sheet.
Right.
So long story short, you know, we were able to fix it by filing an amended return and getting everything correct. And BR was instrumental in helping with all that. So it can be corrected. But if we had proceeded down the path that they were on, they didn't really get great advice going into it, then it would have also impacted their help me guys, their lifetime allotment for their estates, correct? Now,
Sure.
how does that play into something like that?
So in this scenario, you know, the way they did it, it ended up, you know, almost becoming, they unwound it, but they wanted to initially say, well, we'll just give him what he was supposed to get on the back end. You know, it's a family, and and it's like, well, so the question was, well, that's a gift, and it's a large gift, and depending on the size of all the other assets, the amount of all the other assets that he owned, and the laws at his death, it may have used up a large portion of his estate tax exemption or theirs, and left somebody holding the bag on some estate taxes that wouldn't necessarily have had to have been paid if, luckily, we did it the way we did it. But yeah, it could have been bad from that perspective.
You want me to explain estate tax?
Just real high level.
I can do it. I can do it really high level. So everybody has a certain amount of assets that they can own at their death and not have to pay any tax to the federal government by means of something called the estate tax. Now, right now, it's conservative friendly, so to speak. The Republicans have what they want, because right now you can own $11.5 million worth of assets, and anything above that would be taxed at, I believe, 40%.
That's an individual.
Individually.
Okay.
A married couple could have 23 million. Now that law's set to revert and change in 2025 back to, it's going to cut in half. So, you know, if you have a net worth as a single individual, you know, 5.5, 6 million, anything above that would be taxed at 40%. But what people have to understand is the estate tax is something that it's a political chip, and it's constantly on the table. You hear this wealth tax that a lot of presidential candidates have talked about. They weren't really talking about the estate tax, but it's kind of one and the same, where it's just a tax on wealthy individuals. When I started law school, the estate tax exemption amount was $1 million, and that included net worth in your house, life insurance, which includes the death benefit, which you can't even access while you're alive, and retirement accounts, all your assets. And so anything above that was taxed at 55% when you die. And so over the years of my career, it's gone from 1 million to 2 million to 3.5 to 5. And right now it's at $11.5 million. But, you know, if certain people get in office or get control of Congress, there's definitely been proposals over the last 3 or 4 years from the other side of the fence that want it back at about $3 million. And there's been people that have proposed tax rates as high as 65, 70% on anything above that when you die. And so there's a similar law called the gift tax. And so the whole purpose of the gift tax is to say, well, you know, you can own X amount of dollars when you die without having to pay tax. The gift tax says, well, it's for the people that you found a loophole and said, well, I'm not going to own anything when I die. I'm going to give it all away the day before I die, or, you know, before I die, and that way nobody pays the tax. And the IRS hits you that way too. They say, well, if you can own $11 million when you die, you can also give away $11 million during your lifetime, but if you give away anything above that 11, you're taxed at 40%. And so that's what, you know, depending on the client, obviously in 2020, they have to have a huge estate. I mean, relatively speaking, obviously, I think most of us would agree, a big estate to worry about this issue. But still, it's something to consider, especially if we're in a year where the estate tax exemption is a lot lower.
That's great. Everything's kind of interrelated for sure as you think about the different decisions that, you know, sellers have to make. One question we get a lot in our office from the buyers is this, and it's, hey, I'm going to buy this company. What sort of structure should I set up to be the buying entity? right? Does that need to be a C Corp, an S Corp, LLC? How do they think through that? And recently I've seen more C Corps than historically we have because of maybe some tax advantages and things like that. So how do you advise buyers on the structure that they should set up to make a purchase?
Yeah, well, I mean, it all depends on the type of business. But if it's a stock sale, obviously you're not setting up a business. You're taking over the stock of the company you're buying. So you're taking over the corporation or the LLC, whatever it is. If it's an asset sale, again, if you're buying real estate, I would probably segregate that. And that's another good point. If you're buying a business that has assets, and this may have already been mentioned, but you want to make sure that you're buying all the assets of, because a lot of times people will have their operating business in a corporation, maybe an S corporation, C corporation, and I'll explain why in a minute. But real estate is usually held in an LLC. So a lot of times businesses, let's say you're a restaurant, you may operate to the public out of an S corporation, but the underlying real estate, if you own it, may be in an LLC. And so you got to make sure that you're getting all the assets of the business during the sale. But also, if you're doing an asset purchase, you may be purchasing real estate inside of an LLC, some of the other assets in an S corporation or C corporation, and then maybe your business rents the real estate from the LLC. But obviously, liability protection is something that you're looking for. With most people, we'll just get right down to it. Most people pick an S corporation, a C corporation, or an LLC. I mean, if you looked at my law firm, it's a limited liability partnership. There's limited liability, limited partnerships, but for the most part, you're going to deal with an LLC, an S corporation, or a C corporation. All of those, for the most part, are going to protect your assets from your personal assets. And what we mean by that is, if there's a debt of the business, the general rule is only the business is obligated for that, and any of your personal assets that aren't a part of the business usually, will not be subject to that liability. Now, with that said, obviously, if you're taking out a loan for the business, a lot of time a bank will have you personally guarantee that loan. And if you're doing that, well, then your personal assets are, potentially liable for that debt as well. So, but liability protection is one, taxes are another. A lot of people like to set up an S corporation, especially if the owner is working in the business. And if there's any CPAs on the call, I mean, CPAs recommend S corps a lot, so do we, and it's to save self-employment tax. So with an LLC, the general rule is all of your income every year is subject to income tax and self-employment tax, which we all know is your Social Security, your Medicare, unemployment tax, which is 15.3% in addition to your income tax. So with an S corporation, you have the ability to save on self-employment tax. So you can set a salary that you're going to pay yourself each year. Let's say it's $50,000. And that $50,000, you're paying income tax on it. You're also paying the self-employment tax on it. But if you make any money above the $50,000, that's not subject to that 15.3 self-employment tax. And so you'll see that for a lot of the operating entities that are actually paying the salaries.
Yeah, I piggyback off of that. The S corp, we do see that a lot, especially if the owners are working in the business. There are some limitations on how S corps can be owned, and kind of reverting back to that same deal, it had kind of a little bit of everything, but the purchasing entity was buying the stock and they were an LLC, so they weren't, by law, an LLC can't be an owner of a company that's an S corp. So unless they were to structure that differently, they were buying the company that was operating as an S corp, but it was going to lose its S corp election status in the year that they purchased it. So there's some limitations, and that goes into it as well. But yeah, taxes a lot of times, and then the liability protection, not only from a debt, but even from a claim. If you like using Alex's restaurant example, if somebody, if the slips and falls and sues the company, in general, you're going to be personally protected from any judgments that would come from that lawsuit. if you're operating the company truly as a separate entity. So that's the other thing. And then, but yeah, and then but those are the most common. Sole proprietorship is really just not forming any entity and owning it individually. And partnership is a lot of times very similar to that, unless folks have done a partnership agreement, which is hit and miss a lot of times. So yeah, I'd say the LLC, the C corporation, and then the S corporation is kind of a misnomer because an LLC can be taxed as an S corporation as well as a C corporation can. So it's it's kind of a tax election as opposed to an actual type of legal entity in whatever state you're operating in. You would form you would form a corporation, you would form an LLC. The default for a corporation for tax purposes is a C corp, but you can elect to make it an S, and an LLC is either a sole proprietorship or partnership taxation, but you can also elect to have it taxed as an S corp. And again, the reason for that would be to avoid those self-employment taxes.
And I think one of your questions was the C corporation. You're seeing a lot more of those, and that's
especially we did a deal recently where the buying entity was a C corp, and it was because of the 1202 election and
yes.
in the future tax exclusion
yes.
on future sale. So let's walk through that real quick.
Yeah, well, I'm gonna do a high level on this as well. It's been about almost a year since we did that transaction. But the C corporation, first of all, as opposed to the S corporation and the LLC, these are called flow-through entities. And you always hear of C corporations. People, are always, oh, don't set up a C corporation because there's double taxation. And that can be true because a C corporation, as it earns income, that income is taxed. The C corporation has to pay income tax. Now, before this Tax Act that was passed at the end of 2017, that tax rate, I believe it was 39%. And then as the C corporation makes distributions to all of the owners also have to pay income tax as well. And so, obviously that's what people talk about with the double taxation, whereas an LLC or an S corporation, that money that's paid to those entities, it just flows through to the owner's tax return. So the owner ends up paying the taxes on its tax return one time. And so depending on what tax rate the owner is in is the tax rate that it will get hit. So with the C corporation, that Tax Act from 17, that dropped the C corporation tax rate from 39% down to 21%. Now there's still the double taxation. The corporation pays at 21%, and then anything passed through to the shareholder would still pay tax on that money at their rates. But in the situation you were talking about, and the reason I'm not going to get into the details, to even qualify for this 1202 election or 1202 stock, there's quite a few factors that the company has to meet. But in general, what we did was the client set up a C corporation to buy this entity. And when we say 1202, we're just referring to it's just the statute under the Internal Revenue Code that allows this type of transaction. So a lot of times when you hear numbers behind some kind like a 1031 exchange, whenever you're selling real estate, that's just referring to the Internal Revenue Code section. So 1202 stock, I believe it's called qualified small business stock. And what that section allows, if you own or buy or you're set up a business as a C corporation, you have to own it at least 5 years. And then when you sell, you have to do a stock sale on the back end. You can't do an asset purchase, but if you sell that stock later after the 5 years, I believe it's 50% of the gain is completely excluded from the sale. And so in that specific instance, the client was not worried about taking a salary each year because they had other jobs and things like that. So their strategy was going to be set up this C corporation to buy this entity. For the next 5 years, yeah, the company's going to pay tax at 21%, but I'm not paying tax because I'm not distributing out income to myself for the most part. And then after 5 years, we sell, and 50% of the gain is taxed at capital gains rates, and 50% of the gain is it completely excluded. And so that was kind of the reason we structured it that way. It would have been a huge tax savings after the 5 years.
some industry exclusions and things like that, but you can Google that 1202 election and read more about it, or call any of us, and we're happy to navigate that for you.
And that was one of those things that, you know, if the client was going to distribute money, I mean, we did an analysis over the 5 years to say, is this going to save money? Because if there's double taxation for the next 5 years, you know, we were looking at the amount we would save if we sold it in 5 years. And of course, who knows what you would be able to sell it for, but we were just kind of ran a few different scenarios, and it made total sense in that scenario. I think it's going to save quite a bit of tax dollars.
Well, guys, it's 11:30 already. I want to be respectful of everyone's time. I know we could talk all afternoon about some of this stuff. We've got some great stories too, so it's hard not to jump into those. I'm going to open the floor now for questions, right? So if anybody has a question, it looks like you can raise a hand here. We're going to go